Welcome. This presentation will provide an extensive review of municipal debt and how Massachusetts cities and towns can issue it. Please note that additional requirements may exist for regional school districts and special purpose districts seeking to issue debt. In all cases, please consult with your municipal and bond counsels when contemplating the issuance of debt. For the Department of Revenue's official guidance on municipal borrowing and debt, see Informational Guideline Releases 17-21 and 17-22. Municipal debt is debt, ordinarily notes and bonds, issued by cities and towns to lenders in exchange for funds, so that the city or town can fund certain governmental obligations. Debt may be issued to fund the acquisition of capital assets or to undertake a capital project. For example, debt can be used to finance the purchase of fire trucks, school and other municipal facility construction or extraordinary repair of municipal infrastructure, including streets and water and sewer systems, building of parks and playgrounds, and the purchase of land. Cities and towns generally pledge their full faith and credit when borrowing. In some cases, municipalities can pledge a specific revenue stream in order to secure the debt with the lender. Interest on municipal debt is normally tax-exempt, providing an incentive for investors. In order to maintain this exemption, the debt must be properly authorized and issued for a governmental purpose. Any change in use of a debt instrument from primarily governmental use to private entity use can result in the loss of tax-exempt status. Cities and towns in Massachusetts may only borrow as permitted by the legislature through the general laws or a special act. There are laws in place that govern what municipalities can borrow for and for how long, how they can pay off the debt, and how much debt they are able to authorize and borrow. This table references the statutes that govern specific types of projects municipalities may borrow for. The maximum amount of debt a city or town may have authorized at any time is 5% of its equalized valuation, which is the full and fair cash value of property within the community as biannually determined by the Commissioner of Revenue. However, a number of project types fall outside of the statutory limit. Examples of these types of projects will be reviewed in this presentation. Please also refer to DLS's Asset Useful Life Schedules and Maximum Borrowing Terms Guidelines, which will also be reviewed in this presentation, for additional information. A municipality may authorize debt in an amount equal to 10% of its equalized valuation with approval from the Municipal Finance Oversight Board. This table shows the state statutes that govern municipal borrowing limits, purposes, and terms. As stated in the previous slide, local officials should refer to DLS's Asset Useful Life Schedules and Maximum Borrowing Terms Guidelines, an excerpt of which is shown here. The guidelines define the maximum borrowing term for each type of asset or project. The excerpt shown in this slide shows examples of borrowings that apply towards the statutory debt limit, also known as inside debt. This slide shows another excerpt from DLS's Asset Useful Life Schedules and Maximum Borrowing Terms Guidelines. This excerpt shows borrowings that are excluded from the statutory debt limit, also known as outside debt. Debt issuance must be authorized by a 2/3 vote of the local legislative body, which is the city or town council or town meeting. In a city, the mayor may also need to approve of the issuance. In a town meeting form of government, borrowing can be approved contingent upon the approval of a Proposition 2.5 debt exclusion. A vote to do so does not place the exclusion question on the ballot. The decision to present any Proposition 2.5 question to the voters is still made by the Select Board, and authorization is not effective until the exclusion passes. In any vote authorizing a project to be financed by a debt issuance, borrowing should be clearly identified as the funding source, whether it be in the town meeting warrant or the mayor's recommendation to be approved by City Council. Cities and towns may also rescind or reduce a borrowing authorization previously approved by the legislative body. The authorization may be reduced or rescinded only to the extent that no liabilities have been incurred or no third-party rights have vested by issuing debt or executing contracts for the project. Rescission or reduction votes are approved by majority vote of the local legislative body unless otherwise provided by charter, bylaw, ordinance, or otherwise. Before any debt exclusion ballot question is approved by voters, local officials should ensure that the requirements of Massachusetts General Law, Chapter 54, which lays out laws and procedures for municipal elections, are fulfilled. For instance, this chapter requires that the municipal clerk receive written notice of the question being placed on the ballot at least 35 days before the date of the election. The requirements of Massachusetts General Law, Chapter 59, Section 21C, which governs procedures specific to Proposition 2.5, should also be fulfilled. Local officials can find more information about Proposition 2.5 ballot question procedures on DLS's website. At the end of the presentation are the website addresses for various DLS publications and its official guidance. Following the election, a city or town clerk must certify the results of the referendum to the Division of Local Services in the Municipal Data Bank. When doing so, the clerk should provide the text of the ballot question, the date of the election, and the vote tally. If the debt exclusion is approved by voters, additional documentation needs to be submitted when the city or town submits its tax rate recap to DLS. A debt exclusion report, called Schedule DE1, must accompany the submission. For borrowing subject to an approved debt exclusion, the annual exclusion amount, or the community's share of the project's debt service for that year, is the total principal and interest payment due net of any reimbursement received from the state or federal government for the project. If user fees or other local revenues are being used to fund all or part of the debt service, a community may exclude the principal and interest net of the local revenue, but it is not required to do so. This is the additional taxing authority under Proposition 2.5 available to a community each fiscal year until the debt covered by the exclusion is retired. There are multiple individuals who play a role in the debt issuance process. In terms of municipal staff involved, the local treasurer prepares and issues the bonds or notes, which are typically countersigned by the mayor in a city and by a majority of the select board in a town. Municipalities also hire financial advisors to assist with the debt issuance process. The Public Finance Department of a commercial bank or a non-bank advisor usually provides this service. They provide guidance on which type of debt instrument to use and whether it should be issued through a competitive or negotiated sale. The financial advisor will be able to analyze the debt service impacts of various repayment schedules, determine the costs of purchasing bond insurance, and explain various borrowing restrictions. In addition, they prepare various documents, preliminary and official statements, and bid proposals for the issuance. They will communicate necessary information to credit agencies and work with the community's bond counsel on legal and tax issues. In addition, the community's bond counsel is an attorney or law firm engaged to submit an opinion on whether a borrowing has met all legal prerequisites for debt issuance. In order to do so, bond counsel will draft and review borrowing authorization votes, town meeting warrants and notices, certify the presence of a quorum during any such votes, and ensure that all local charter and bylaw instructions are followed. In the case of a contingent borrowing vote, under Proposition 2.5, the bond counsel can also review the potential ballot question to be linked to the borrowing. Bond counsel will also assist with receiving any state agency approvals necessary for the issuance and provide a legal opinion that confirms the municipality has the authority to issue debt and that an issuance is tax exempt. A rating agency's function is to render an opinion on the municipality's likelihood of default on debt obligations. Most Massachusetts cities or towns receive bond ratings from Moody's Investors Service, Standard & Poor's, and/or Fitch Ratings. This table shows the different grading systems used by different rating agencies. In addition, the agencies will assign a positive, stable, or negative outlook assessment for each rating. Typically, higher-rated communities garner lower interest rate charges. In conducting an assessment, the rating agency will analyze financial statements, management capability, fiscal stability, economic condition, and other data. The process will often include in-person or telephone interviews with municipal finance officials. On less frequent occasions, a ratings analyst will make a site visit to a city or town to gain a more substantial understanding of its assets and management capabilities. The agency will then issue a report that presents the rating assignment and describes the community's financial position. Purchasers of municipal bonds and notes use this rating when considering their bids. Depending on the situation, a city or town may choose to issue either long-term or short-term debt. Long-term debt issuances have maturities greater than 1 year. Once the debt is issued, the municipality makes principal and interest payments to the bondholder based on a fixed schedule. The most common type of long-term debt issued by Massachusetts cities and towns is general obligation debt. Municipalities pledge their full faith and credit to pay off the obligations, which typically mature in anywhere from 5 to 30 years. These bonds are typically competitively marketed nationwide. The Massachusetts Clean Water Trust also provides low-interest loans for up to 30 years to fund local drinking and wastewater projects. Zero-interest loans are also available to fund utility projects in rural areas from the U.S. Department of Agriculture. 10 years is the maximum term of these loans. The USDA also assists rural communities through its Community Facilities Loan Program. Low-interest loans are offered to rural communities to purchase, construct, and improve essential community facilities and equipment, such as healthcare facilities or public works vehicles. The maximum term of these loans is 40 years. The Commonwealth's Qualified Bond Program allows municipalities to issue general obligation bonds payable from its local aid distributions. Bonds issued through the program benefit from the strength of the state's credit rating since the payment source is state aid. This, in turn, results in lower interest rates on debt issuances than what might otherwise be possible if the debt were paid locally. The Division of Local Services works with the State Treasurer's Office, who administers the program and ensures local aid distributions are intercepted to fund the repayment of interest and principal on the outstanding bonds. Each city, town, or regional school district must receive authorization to issue state qualified bonds by the Municipal Finance Oversight Board, which is chaired by the state auditor. When reviewing applications, the Municipal Finance Oversight Board ensures that the bonds are being issued for an allowable purpose, such as a capital project or final judgment payment. The board will also analyze whether the municipality's local aid amounts will be enough to pay down the amount borrowed. Bond proceeds must be spent within certain timeframes, shown on this slide, to comply with federal arbitrage rules. Exceptions to these spending timeframes can be made for small issuers who borrow less than $5 million of tax-exempt debt in a calendar year, or $15 million in the case of school construction. Local officials should consult with their financial advisor and bond counsel to ensure compliance. Principal payments on long-term debt are made in annual amounts. The first debt service payment takes place no later than the end of the fiscal year that begins after the date of issue. There are two primary repayment structures used to pay off debt obligations. The first is level debt service structure, in which the combined annual amount of principal and interest payments remains relatively constant over the life of the bond. The second payment structure is called level principal, in which only the amount of principal payments remains relatively constant over the life of the bonds. This results in debt service payments that are initially higher but decline over time. Local officials can project different payment structure scenarios using the debt service calculator available on DLS's website. Both level debt service and level principal structures can be compared. The financial management team should consult their financial advisor to make the ultimate decision on which structure to use. Refunding a bond is like refinancing a mortgage to take advantage of lower interest rates. New debt is issued in the form of refunding bonds, and the proceeds are used to retire the outstanding debt. The City Council or Select Board may authorize refunding bonds or notes for the purpose of paying or refunding all or part of a previous bond or note issuance. In most cases, a refunding can only take place if it results in debt service savings. There are exceptions made when a refunding is needed to correct the tax-exempt status of the outstanding debt. The term of the refund borrowing must be within the original term authorized for the bonds or notes to be refunded. The issuance of short-term debt allows cities and towns to borrow funds on a temporary basis in anticipation of collecting certain revenue sources or issuing approved long-term debt. This type of borrowing allows a community to make interest-only payments until the anticipated revenues or financing source is secured. Short-term issuance typically lasts no longer than 2 years, but can be renewed with a principal payment. Short-term debt can be issued through instruments, which will be detailed in the following slides. Bond anticipation notes, or BANs, are an instrument used to generate cash for initial capital project costs. BANs temporarily finance projects in anticipation of issuing long-term debt, such as a general obligation bond, and are paid off with the proceeds from such an issuance. Once a city or town has voted to authorize debt for a project, it may issue bond anticipation notes in anticipation of issuing the permanent long-term debt. BANs may be issued by the same municipal officers authorized to issue the permanent debt. BANs may be renewed for up to 10 years from the date of issue. However, principal payments are required beginning in the 3rd year until the permanent debt is issued or the loan is paid in full. Each principal payment must be at least equal to the minimum payment that would have been required if the BAN had been converted to long-term debt. BAN proceeds must be spent within certain timeframes, shown on this slide, to comply with federal arbitrage rules. As with long-term debt, exceptions to these spending timeframes can be made for small issuers who borrow less than $5 million of tax-exempt debt in a calendar year, or $15 million in the case of school construction. Local officials should consult with their financial advisor and bond counsel to ensure compliance. This table illustrates how BAN paydown procedures work. In this example, the legislative body has voted to authorize $100,000 in borrowing for 20 years to finance a local capital project. Note that the principal payments do not begin until the third year of issuance. After 10 years, $55,552 in principal balance remains. Long-term debt must be issued to finance this amount. Because the original borrowing term was 20 years, the permanent debt must now be issued for a period not to exceed 10 years. A Revenue Anticipation Note, or RAN, is a short-term loan paid off by local revenues, such as tax collections or state aid. RANs, which are issued for a maximum of 1 year, are used to stabilize cash balances until receipt of quarterly or semi-annual tax payments from residents or local aid distributions from the Commonwealth. In a city, these notes may be authorized and issued by the treasurer and typically countersigned by the mayor, unless the city's charter states otherwise. In a town, the treasurer may issue the notes with a majority of the select board countersigning. No vote of a municipality's legislative body is required for RAN issuance. RANs are full faith and credit obligations of a city or town, meaning the city or town agrees to unconditionally guarantee that it will fulfill its debt obligation. The amount borrowed through a RAN issuance cannot exceed the total of the tax levy from the preceding fiscal year, the net amount collected for motor vehicle and trailer excise during the preceding fiscal year, and payments during the preceding fiscal year by the Commonwealth in lieu of taxes for property taken by it for institutions. Cities and towns are able to borrow in anticipation of grants to be received from the federal government or the Commonwealth, or any agency or department of either. Proceeds can be used to fund expenses that will be financed by the grant. In order to borrow in anticipation of a grant, the grant must be for a purpose for which a city or town can borrow for 5 years or more under Massachusetts general law. The grantor of the funds must also have agreed to the grant award. Once received, grant proceeds are used to pay off the loan without any further appropriation. The term of grant anticipation notes cannot exceed 2 years. Massachusetts general law permits for 2 types of grant anticipation notes. Borrowing for grants awarded for highway purposes are governed by Massachusetts General Law, Chapter 44, Section 6. Borrowing in anticipation of this type of grant requires a majority vote of the municipality's legislative body. Borrowing for grants awarded for other purposes are governed by Massachusetts General Law, Chapter 44, Section 6A. In a city, these notes may be authorized and issued by the treasurer and typically countersigned by the mayor, unless the city's charter states otherwise. In a town, the treasurer may issue the notes with a majority of the select board countersigning. Cities and towns are also able to borrow for the portion of a public works project that will be funded by a federal grant. In order to do so, the local legislative body must approve the project and authorize debt to finance the municipality's share of the project costs. The city or town must also have a signed commitment letter from the federal agency awarding grant and have approval to borrow for this purpose by the Municipal Finance Oversight Board. The maximum issuance for a federal public works grant anticipation note is 2 years. However, the notes may be renewed for as long as the grant commitment is outstanding. Massachusetts general law allows cities and towns to deficit spend to address emergency needs in the wake of major disasters, including but not limited to flood, drought, fire, hurricane, earthquake, storm, or other catastrophe that poses an immediate threat to the health or safety of a community. Emergency deficit spending can be funded either by appropriation, the following year's tax revenues, or through emergency borrowing. In order for emergency spending to begin, an emergency declaration must be approved by the governor or a majority of a select board in a town or 2/3 of a city or town council. In addition, the Division of Local Services Director of Accounts must provide approval. Eligible expenses include employee overtime, debris removal, contractual assistance, and emergency repairs for public buildings and infrastructure. Emergency expenditures may be funded through borrowing on a short-term basis or for a longer term. When borrowing on an emergency basis, cities and towns typically can issue debt to fund the emergency expenditures with a maximum maturity of 2 years. The debt may be authorized by the treasurer with the approval of the municipality's chief executive officer, typically the select board in a town or mayor in a city. The Division of Local Services Director of Accounts must approve of any emergency debt issuance. A city or town seeking to borrow on an emergency basis for a term longer than 2 years must do so with the approval of the director. The director may approve for borrowing terms up to 10 years. Municipalities may not borrow for the funding of collective bargaining agreements or items previously disapproved by the legislative body for the fiscal year in which the borrowing is sought. Municipalities may also borrow for longer periods to fund emergency capital expenditures authorized by treasurer with approval of the Chief Executive Officer of the city or town. In this case, borrowing to fund these expenditures must also be approved by the Municipal Finance Oversight Board, or MFOB, the term of which may not exceed the term for the borrowing purpose. In order to receive approval, the city or town must demonstrate that the regular debt authorization process poses undue hardship in meeting emergency needs. How premiums are accounted for depends upon when the note or bond was sold, before or after November 7, 2016. First, let's review accounting for premiums on notes or bonds sold before 11/7/2016. These premiums on bonds or notes sold before 11/7/16 belong to the general fund. If a debt exclusion was approved for the borrowing, the premium must be reserved for appropriation to offset interest paid in future years, and the amount excluded each year is reduced by premium adjustment or appropriated to pay project costs and reduce the amount of the borrowing. Second, here is the accounting treatment for premiums on notes or bonds sold after 11/7/2016. These premiums, net of issuance costs, received as a result of the issuance of bonds or notes, are not treated as general fund revenue. The net premium must either be 1. Used to pay project costs and to reduce the amount of the borrowing authorization by the same amount when the borrowing vote so authorizes, or 2. Reserved for appropriation for capital projects for which a loan has been or may be authorized for an equal or longer period of time than the loan for which the premiums were received. If voters approved a Proposition 2.5 debt exclusion for the particular borrowing under General Law, Chapter 59, Section 21CK, the amount excluded must be adjusted to reflect the true interest cost of the borrowing. General Law, Chapter 44, Section 20. Therefore, premiums received for debt excluded borrowings should be applied to pay project costs and reduce the amount of the borrowing. If not, the premium must be reserved for appropriation for other capital projects, as previously stated, but in this case, there will be an annual reduction to the amount of the exclusion. For more information on the treatment of premiums, including for excluded debt, please review guidance available on the Division of Local Services website. The location of this guidance will be at the end of this presentation. The amount of the surplus is determined at the time the purpose, project, or acquisition is completed, regardless of when the loan was authorized, the bonds or notes were sold, or purpose completed. The amount of surplus proceeds is the difference between the amount borrowed and the amount actually spent to complete each purpose for which the city, town, or district has authorized debt. Selling bonds or notes for multiple authorized purposes at the same time does not alter the purpose, term, or amount of each loan. If the amount of bond proceeds remaining after a project is completed is $50,000 or less, the surplus proceeds may be applied to the payment of debt service with the approval of the Chief Executive Officer. A city, town, or district may abandon or discontinue a borrowing purpose, project, or acquisition if no liability remains outstanding and unpaid by a 2/3 vote of all the members of the City Council or a 2/3 vote of the voters present and voting at an annual town or district meeting. The proceeds remaining after a borrowing purpose, project, or acquisition is abandoned or discontinued may be appropriated for any purpose for which a loan may be authorized for an equal or longer period of time than that for which the original loan, including temporary debt, was issued. Where the project is abandoned or discontinued, there is no option for the Chief Executive Officer to approve the application of the remaining proceeds of $50,000 or less to the payment of debt service. However, the amount of the debt exclusion for the project must be reduced when the debt excluded proceeds are appropriated for a project that is not also debt excluded. Surplus loan proceeds in any amount remaining after the project is completed may be appropriated for any purpose for which the municipality may borrow for an equal or greater term than the term for which that loan was issued. When there is a surplus of $50,000 or less, however, the municipality may apply the surplus to the payment of any debt service with the approval of the Chief Executive Officer. However, surplus proceeds remaining after the completion of a project financed with restricted funds, such as an enterprise fund or community preservation fund, remain subject to the relevant restrictions of the fund. The amount of the debt exclusion for the project must be reduced when the debt excluded proceeds are appropriated for a project that is not also debt excluded. Please refer to IGR 2017-21 and 2017-22 for more information. The Division of Local Services plays a role in the oversight of municipal borrowing. The division is also represented on the Municipal Finance Oversight Board, or MFOB, and approves notes issued through the State House Notes Program. Additional information about the MFOB and the State House Notes Program is available on DLS's website. DLS's Director of Accounts also sets the maximum borrowing terms and useful life of assets for some issuance purposes. The borrowing purpose table, which sets forth these terms, can also be found on DLS's website. The Division of Local Services also works with the Office of the State Treasurer and Receiver General to ensure cities and towns do not default on debt service obligations. If a municipality is able to certify to the division that it will be unable to make a debt payment, and the division agrees, the state treasurer is notified. The payments are then paid directly by the treasurer out of local aid payments to be made to the community from the Commonwealth. For more information on specific programs mentioned in this presentation, please visit these links for the United States Department of Agriculture, Massachusetts School Building Authority, Massachusetts Clean Water Trust, and the State House Notes Program. For the Department of Revenue's official guidance on borrowing, please see IGR 2017-21 and IGR 2017-22. For more information on Proposition 2.5, please see the DLS publication, Proposition 2.5 Ballot Questions, Requirements and Procedures, August 2017.